Imitation is the best form of flattery. So mutual funds have become so popular today that there are a bunch of copycat products that try to look and sound like mutual funds. So many insurers like PNB MetLife, Bajaj Allianz, Max Life, etc. have launched small cap funds, index funds, etc. which look exactly like mutual funds in recent times. But these are actually unit linked insurance plans or ULIPs and not mutual funds. So how can you tell the difference between ULIPs and mutual funds? In this episode of Question of Money, that is exactly what I'll be telling you. The first one is the benefits they offer. In a mutual fund, the only benefit you can expect to get is the returns that you earn on the underlying asset. So if you invest in a mutual fund at the current NAV and the NAV jumps by say 25% because the fund has invested in stocks or bonds which have gone up, then the 25% return is the only thing you get. Whereas in a ULIP, you are offered two benefits. One is an insurance cover on your life and the other is the investment returns that you get by the fund investing in stocks or bonds. Out of the money that you invest, a certain portion goes into the mortality charge which goes to ensure your insurance cover. Only the remaining money in a ULIP is invested in stocks or bonds. In a mutual fund, you can exit anytime you wish at the prevailing NAV, and this is without any extra cost being charged. ULIPs are usually 10-year plus products. Some ULIPs may go on to 15 years or 20 years also. In a ULIP, your investment is compulsorily locked in for the first 5 years. You cannot withdraw the money before this period. Suppose you opt for surrender before this 5-year term, then you will have to wait for 5 years even to get that amount. In a ULIP, you commit to paying a fixed premium every year for 10 or 15 years, which is the policy term. In a mutual fund, there is no fixed commitment. You can invest as little or as much you want every year. Even if you sign up for a SIP, you can pause the SIP if you don't have enough money to invest and resume it when you do have the money. In mutual funds, the only cost you incur is the total expense ratio or the TER that is charged by the fund. This is the fee charged by the fund manager for managing your money. SEBI caps the TER at 2.25% for equity schemes and 2% for debt schemes. In the case of ULIPs, there are multiple charges that you end up paying. The first is the mortality charge which goes towards the insurance cover, but besides this you can have policy administration charges, premium allocation charges, surrender charges if you opt out early, even top-up charges, rider charges, etc. Now IRDA, which is the regulator for ULIPs, says that the difference between your gross and net returns in a ULIP should not be more than 2.25% for schemes which are less than 10 years. It caps this difference at 3% for schemes that are more than 10 years. In a mutual fund, if you look at the NAV, you can gauge exactly what returns you are going to make. This is because the NAV of a mutual fund is disclosed after deducting all the fees and charges. In the case of a ULIP, this is not the case. The returns that you see on the NAV may not be the returns you get. This is because all the costs and charges in a ULIP are adjusted against your unit balance. This is also why there are many databases that allow you to compare the performance of various mutual funds based on their NAV. So suppose you want to look at the performance of small cap funds, there are databases like Value Research where you can simply log on and check how your fund is doing against its peers and against its benchmarks. This kind of a comparison is more difficult with ULIPs because your NAV may not tally with your returns. So all this goes to show you that mutual funds are more investor friendly, more liquid and more transparent than ULIPs. Well, if it's a ULIP you are looking at, there can be three factors to look at. One is whether it's being sold by an insurance company. Usually ULIPs are sold by companies with the word life in them. Secondly, you will find descriptors such as non-participating, market linked, etc. when you are actually being sold a ULIP product. Thirdly, when you buy a ULIP, what you are paying is actually a premium and there is a GST component to it. Whereas in a mutual fund, the investment you are making is not called a premium. So these are three ways to be aware of whether you are buying a mutual fund or whether you are buying a ULIP.